Stop deferring tax. Don't make these 7 tax mistakes or you'll end up paying more than your fair share. If you want to pay less tax, stop deferring. Don't delay, truly save tax. Look, there's 7 reasons not to defer. You might be in a higher tax bracket in the future. Most deferral plans don't give you access to money. When saving and delaying are different things. Often these plans have high expense and plenty of complexity. There's a lack of control with the plans, and money's actually stuck in the plan and not actually in your pocket. So money loves momentum. Let's talk about fast money. See, deferral is different than savings. If you're going to defer, learn about things like cost segregation if you own a building. That's one deferral that might make sense, where you can accelerate your depreciation. And because it's real estate, you have plenty of options. You can roll it over to another property. You could do a charitable trust to avoid the taxes upon the sale. There are options. And there's other ways that you can look at smoothing out distribution of the sale of an asset. So here's some easy and immediate ways to save tax. If you have a business and then you have just employees like your family, and you have a gym or a pool or cold plunge or hot tub, you can use 132J to write off all that maintenance. The biggest thing is Section 199A of the Internal Revenue Code. That provides up to a 20% deduction on qualified business income for certain taxpayers. All right, that was part of the Tax Cuts and Job Act of 2017 to offer tax relief to owners of pass-through entities like LLCs, S-corps, right? Another one is 280G, the Augusta Rule. That means that you can rent out your home 14 days a year. Now, you can rent that to someone else. You don't have to pay tax on the income that comes in if it's 14 days or less. Or if it's your business, you can write it off for using it for your business, a team retreat, filming throughout your whole house for something that's going on, or, maybe it's even having clients over. So you can write that off, but you don't have to claim it as personal income if it's 14 days or less. But what's really important for fast money is reclassifying your income. There's ways to go from active to passive income, ordinary income to capital gains as you grow, and there are tax-free options, especially if you're charitable or if you know about things like Section 1202 with the C Corp. This is money in your pocket immediately. Now, this might sound like, like that's a lot of jargon. Well, stay with me. We'll give you some resources and help you through this. But I want to start by saying, what's funny about tax? Nothing. No. Taxes suck. They say there's only 2 things you can count on in life: death and taxes. That's a bit redundant since most people would rather die than actually pay their taxes. It's funny, the government calls this a voluntary system. Yeah, you voluntarily pay or voluntarily go to jail. And while income taxes do suck, there's like a dozen other taxes they can get you with too. You have to pay tax to work, to live, to drive, to eat, to buy, to sell, and hell, even when you die. So not even dying is a way out of tax. There's even a sinner tax, which is extra tax on things like alcohol, tobacco, and marijuana. So sure, you can forget about your troubles, but you have to pay more to do it. There are tax breaks, though. Like when you have kids and you bring the government future revenue in the form of all new taxpayers. Joke's on the government, though, because you guys know a lot of kids don't work, and they're just so much more expensive than the tax break that they're hardly worth the write-off. Joking, of course. So if you hate paying taxes or overpaying taxes, pay attention, because deferring is not necessarily saving. Here's the first of the problems: when we confuse money in the plan with money in our pocket. Okay, so I was once on this podcast and they said, hey, you know what? You should put money in your IRA and take that tax savings and buy something of Garrett's, one of his programs. He's great. I'm like, how are you going to buy it? The money's stuck inside of the plan. Yes, you paid less tax because you didn't take constructive receipt of the income, but you can't spend it and you still owe it in the future. Right? So that's part of the problem. The other issue is when we look at what's gone on with the tax brackets, they're over 50% from 1944 to 1981. What happens if they raise taxes in the future? See, between 1944 and 1981, the U.S. experienced significant fluctuations in federal income taxes, especially affecting high interest earners. So let me kind of go through just some of the periods and give you a sense of this. 1944, the very top tax bracket was 94%. Now that seems insane, right? 94%. Now you had to make a certain amount of money to hit that because that's called a marginal tax rate. So an average tax rate is if you take whatever you made, divide it by what you owe, that tells you a percentage. So if that was $1 million that you made, you paid $170,000 in tax, that's a 17% rate. But like the first $30,000 earned was only taxed at 10%. Then it steps up to 15%. Then Then it steps up to 25. I'll talk about this a little bit more. That's your marginal rate. What's nice is when you save tax, you save off your highest rate. So no matter how much more money you earn, they only tax at the higher rate than new dollars. They never go back and raise all your taxes. Everybody pays the same rate on the first dollars. No matter who you are, it's a lower rate than when you're really wealthy, you're making a lot of money. Yeah, those last dollars could get hit at 94%. In 1945, it was still 94%. Went all the way down to 86.45% in 1946. Stayed that way for a couple years and went to 82.13%. By the time we get in the 50s, it's back up to 92%, 91%. All the way in 1957, it's at 91%. Stayed that way through 1961, 1962. It's at 91%. Imagine getting a check in 91%. Now, finally, 1964, it drops to 77%. It gets down to 70% at 1967, 1968. And then it comes back up to 77% in 1970. So these are really high numbers. And through most of the 70s, we're at 70%. I guess that's what they thought the 70s meant, was 70% top tax rate. I know, bad joke. Even in 1980. Then finally in 81, it gets down to 69.13%. So that's the top bracket. The top marginal rate is the highest percentage of tax applied to the last dollar of taxable income. See, the federal income tax brackets for 2024 in the U.S., this is what it looks like for, marginal rates. So if you're single, it's 11,600. You don't, from 0 to 11,600 is 10%, but if you're married, it's 23,200. Now it's 12% from 11,600 to 47,150 if you're single, or 23,200 to 94,300 if you're married. So only 12% up to 94,000. Then it jumps to 22% from 94,000 up to 200,000, or 47,000 to 100,000 if you're single. Then it goes to 24% from 200,000 to 383,000. Then it jumps up to 32% from 383 to 487, then 35% from 487 to 731, and then for 37% for anything over $731,200. That's your marginal rate. No matter how much more money you make, they don't go to your earlier dollars and tax them higher. That's really important to know. But as you get older, a lot of times people sell their business so they have less tax deductions, or their kids are out of the house. They don't have those tax deductions. And you might need the same amount of money or even more due to inflation. And look, the government's talking about increasing rates or changing marginal rates. So you get to that top tax rate sooner, so that instead of having it kick in at 11,000, maybe they go down to 8,000, and then all of a sudden you're in the next highest rate. Or instead of waiting all the way till 700,000, they start that at 500,000. They can change the marginal rate so that you get to the top rate sooner. The second issue with deferral is you're locking money away. There's a lack of control. So you miss opportunities along the way. You might be overly reliant upon a stock market you don't control. There's no cash flow that's happening with it because it's tied up and one-dimensionally reinvested in the plan. There's tons of restrictions if you want to get to that money early. See, you lack control. The third thing is these plans have tons of expenses. There's a lot of complex plans out there, like defined benefit plans. We have to contribute to compensate for bad markets and losses for your employees. So it's not only what you're putting in there, it's what you're guaranteeing for your employees, which gets you the tax deferral. We had a dentist that wanted to collapse their defined benefit plan. It took 19 months to collapse that and get to their money and roll it over. So what does it cost to administer these plans? And when do you actually get to the money? How are you going to get to the money? These are some of the things to consider. And you don't have to have the overly complex ones. There's 401ks and IRAs, but they still have the same issues, maybe just not as big. The fourth thing is if you save tax, that means that you don't have to pay it. Delaying tax, that means that you have to pay it eventually. So one says you don't have to, one says you don't have to right now. So how did you actually save? If you just deferred, now you're like, oh, well, I have uninterrupted compounding, right? That's what a lot of people believe. I have uninterrupted compounding. So let me pull this up because this is the fifth point. So you can see that if in the dotted line, it's going to grow to more. It grows to like 700,000 if it goes in pre-tax. It only can grow to 500,000 if it's after tax. But when you pull the money out and you pay the tax on it, you're going to get down to $500,000 because that's 30% less than 700. So you think, oh, look, there's more. There's 700,000. Yes, but you still have to pay the tax on it. Where in the Roth, you can now pull the money out tax-free. So this uninterrupted compounding is kind of a myth because not only is there compound interest, there's compound tax. The government's tax grows with it. So I could show this in another way. If you're putting $10,000 into a plan, it shows that you have $10,000. But if you go to take that money out after 59.5, you get $7,000 and the government gets $3,000. if you're in a 30% bracket. Well, guess what? Let's say that it grew. And your Roth IRA, if you have $7,000, let's say that grew to $70,000 after tax. But if you could put it in pre-tax, it grew to $100,000. When you go to pull that $100,000 out, guess what? You're going to net $70,000 because of the tax. The compounding interest also compounds the tax. It's deferred in the plan. So the sixth issue here is, even if the plan has more money, how do you access and get benefit from that money? Might be underutilized because you have to wait till 15 and a half. You might have taxes when you go to pull it out. So you're like, I don't know if I want to take it out. You'd have to find tax offsets. This means it's a lack of an exit strategy. So how does it benefit you? See, if you hate paying tax today, I think you're not going to stop paying it later. You might hate it even more. I kind of feel like when people get old, the committee in their head that's like, filters things, passes out, dies. And it's like first thought that comes out. I remember my grandma, I saw her a few years ago. She's like, what is wrong with your hair? You think you're Jesus or something? Right? Like, just, she was never like this. She's always really nice before. But, the older she got, the more grouchy she became, the more she was like, this sucks. So the seventh issue is you might actually be in a higher tax bracket. The government spending right now created a $36 trillion debt. So that could be an issue. Less tax advantages, more money just to have the same amount net spendable because of inflation. These are all issues. So let's recap this. You might be in a higher tax bracket, might not have access to money along the way. Saving and delaying are different things. Why don't I have full tax strategy? High expense and complexity of the plans because there's fees that are now associated that drain part of your returns, or that you don't have that access to that money. You have no control over what happens. It's a tax code. Money's in the plan, not in your pocket. So here's my rant. Don't let the tax tail wag the dog. How's this actually going to benefit you? Tax tail wagging the dog. Some people spend their money in ways they never would just in the name of tax. It doesn't make sense to spend $1 to save 37 cents if you weren't going to spend that dollar anyway. And if you're going to put money in a plan, but it's not in your best interest just because you think of the tax advantage, there might not even be a tax advantage. See, I think it's important to think economics first. How does this benefit me? What good does this do? And then look at the tax advantage second. That way we don't make irrational decisions. There was a thing in the 80s called negative gearing, where people could buy these dilapidated properties, kind of like similar to opportunity zones today. They buy these dilapidated properties and they got huge tax advantages for it. And then 1987, Reagan's like, we're going to do away with those tax advantages. And all of a sudden they had worthless property because they didn't think about the economics first. See, the worst idea though is a lot of people, like I grew up in a coal mining town where people said, I don't want to work overtime. It's going to kill me with taxes, because they believed when they got in a higher tax bracket, it taxed all their dollars, not just that last dollar. Even when we looked at 1944, and it was a 94% tax rate, if you earn another dollar, you still end up 6 cents richer, which doesn't sound great, but it's still more than if you didn't earn the money. Too many people think they should stop earning money to save tax. That's one of the worst ideas. The best tax shelter in the world is to earn another dollar. Always put more money in your pocket. Always focus on being a value creator, even if it means you pay more tax. So what would MJ do? What would Money Jesus do? Look, my friends think I'm Jesus. I know that, because when they heard I was going to write a book on money, they all said the same thing. That'll take a miracle. Well, guess what? We hit New York Times with it. Holy crap. Holy crap. So here's what I would recommend. Number one, build your tax team. What does that tax team look like? Well, if you're just starting out, it might be a bookkeeper. And even if that has to be you, as time goes on, eventually get someone else, because timely data matters. If you're an organization, that might be the controller or a CFO. The second thing is, in the team, you want a tax strategist, not a historian. A tax strategist proactively helps you navigate tax deductions. There's so many tax deductions out there that people miss. I said right at the beginning of this, Section 199A, 132J, 280G, just to name a few. I know people that say, oh, my accountant says I can't write off a home office. Well, that were true if it was before 1996, but it's been that you could write that off since then. When people say they're conservative accountants, usually what they say is, I'm missing deductions, I want you to be mad at me. Or when they say, oh, I don't want to create any red flags, what I'm talking about here doesn't create red flags. It's in the tax law. But far too many people are afraid of the IRS, and they have a team that isn't good at helping them maximize their deductions because they're too busy filing returns. And that's commoditized. You want a tax strategist, not a historian. Now, as a business owner, you want an attorney. The type of corporation you choose has a major impact on your taxes. LLCs and S-Corps are pass-through entities. You pay tax whether you pull the money out or not. A C-Corp can retain earnings. But there's a difference between an LLC or an S Corp. If you're an LLC and you have a business partner, you can shield yourself from their liability and you have flexibility. One person could take more income. The other person could take a bigger tax advantage. You have a lot of flexibility. You don't have that with an S Corp. S Corp's a great solo company. When you want a cash cow where you're the only one that's taking money as an owner and the rest of the people are employees. But a tax strategist is going to help you with deductions. An attorney can help you in classifying your income. And how we classify our income is a big way that we could save on tax. Now, if you haven't made $1 million, maybe a regular corporate attorney will do. If you're over $1 million, a tax attorney is going to be key. And as I mentioned in the very beginning, if you own a commercial building or commercial buildings, you want to look at an engineer, specifically a cost segregation engineer. So let's talk about maximizing deductions. The best way you do that is simply document what you spend and then say, could this or does this relate to my business? And if you're not sure, meet with your accounting team to verify what can be written off and what can't be. You can write off trips if you're doing your corporate meetings there. Maybe not the whole trip, but you have to have corporate compliance and have to have an annual corporate meeting, so that could be helpful. You could write off certain things that you use in your business, but you also get to enjoy personally, but you won't be able to write off the whole thing. But you have those conversations. Let's talk about the big one here. Reclassifying your income. Moving from active to passive, or ordinary income to capital gains, or having something that's tax-free. Now, active to passive could be if you own your business, you can be an S corporation and take a reasonable salary, and then anything above that comes in distributions, and it's not subject to self-employment tax, so it could save you up to 15.3%. Active to passive, that's an example. Or if you own a building, you can charge yourself the highest possible rent comparably, and that's going to come in 1099, and that's going to be better than W-2 income from a tax perspective. All right, ordinary to capital gains. Ordinary income, if you're not making a lot of money, it's not going to make a big difference. But once you get into the top tax bracket, which is, right now 37%, capital gains will be 20%. So when you own an asset like a business, that's capital gains, or a piece of real estate, or an individual stock, and then there's ways that you can exit those tax-free through charitable trusts and other ideas like that. Now, some things are, there are things that you got to be careful with. Like, here's something that a lot of people abuse and they misuse. It's called an 831B, a captive insurance agency. Some people go, I want to do that for tax purposes. But what it really is an insurance company. So if you're a big enough company, you need to insure some things on your own, and you can drop commercial insurances and save money. Well, when it goes in pre-tax to your captive insurance agency, which insures your businesses. And then when you pull the money out, if there's no claims, it's capital gains. But the problem is a lot of people do that for a tax benefit, and they don't do feasibility studies, and they don't make claims when there are claims to be made, and then the government's not going to allow that. Tax-free, there's a couple things. I mentioned 1202 at the very beginning. If you ever plan on selling a business and your business qualifies, well, if you're a C corporation, you own it for at least 5 years, you can sell up to $10 million tax-free per person, per partner. That's great, right? Or charitable trust, where you can donate to a charity, not pay taxes on the gains, and live off that asset during your lifetime and leave at least 10% behind to the charity. That's a really rudimentary version. You want to meet with an attorney to get the details about this. I'm planting the seeds. And by the way, if you want to know how to do these things, I have a checklist. It's called my Tax Navigator. If you want to get the Tax Navigator, go to Garrett B. Gunderson on Instagram and go ahead and put Tax Navigator in DMs, and we'll send it to you. It's got a checklist of the top things you could do that are right down the fairway, easy to do, so that you're saving tax instead of delaying tax. And it's going to help you with an understanding of what this model is that I'm talking about shortly here on this podcast, so that you can start to implement in your life. So instead of tipping the government, because tipping the government's like tipping a waiter who ate 37.5% of your soup and peed in it. You know what I'm saying? Like that, you don't want to tip the government. We're going to pay plenty of tax with all the excise taxes, sales taxes, property taxes, and everything. There's no reason to pay a penny more legally and ethically when you're in the know. Get the Tax Navigator. I'm so glad that you're watching, listening, or however you get this.